Welcome back to Rich Dad StockCast. I'm your host, Denney, and today we're breaking down one of the most respected investors of all time, Warren Buffett, the Oracle of Omaha. Now, Buffett, he's built one of the greatest fortunes in history using a set of principles that millions of investors still follow today. But here's the real question. Do those rules still work in today's market? We've got AI, high-frequency trading, options, volatility, and a faster-moving environment than ever before. So today, Rich Dad expert Andy Tanner is going to help us separate what still works from what needs to evolve. Now, before we dive in, go to stockcastbonus.com. Grab your free investing tools. If you want timeless principles and modern strategies, that's where you start. Andy, welcome back.
This is going to be awesome, man. Someday, we talk about the late Charlie Munger, and Buffett's not a spring chicken. And I don't know how I'm going to feel when it's his turn to close the chapters of his life, and then that book will be written. I remember when my college basketball coach passed away, Rick Majerus, and he was closer to guys like Van Horn and Andre Miller and Doliak. But I'll tell you, I just wept when he passed, and I thought, why am I so emotional about this? I mean, he was my coach, but it's different than a father dying. And the reason I realized I was weeping is because an absolutely unimaginable encyclopedia of basketball knowledge was now silenced and closed. And all we have is scraps of what we know about it. And we can't draw from that anymore. The fountain doesn't, we have the jugs of water, but there's no more fountain. And when Warren Buffett passes, his annual letters are already, it's akin to financial scripture. That's really what it is. I mean, it's unspeakable that a lot of Gen Zers don't even know who he is. And there's been no one that I've studied in terms of stocks, certainly in general education, financial education. I've learned so much from Robert, but when it comes to stocks, there's no one I've studied more and no one I have more indebtedness to than Warren Buffett. So mass respect. Just the guy is the GOAT, man. And Jim Simons is a trader, and he had a better percentage than Buffett. He did about 60% a year before fees. Buffett's have been in the low 20s, but as a pure investor, Buffett takes that trophy for sure. He's the GOAT.
He is the GOAT. Now let's start with some of the core investing principles, that Warren Buffett's known for. Let's break them. They're simple. But let me ask you this. Before we get into like the nitty-gritty, why have they stood the test of time?
What it's so interesting. The time I spent with Kim Kiyosaki and Robert Kiyosaki and some of the experts that Rich Dad draws upon. As I've gotten older now, I mean, I spent 14 years actively traveling on that team, and now my kids are playing basketball. I don't want to miss games, so I do everything from my home studio. So you don't see me on stages anymore. I like being at home. But as I think back of that 14 years that I spent, that's a long time. And the lessons that I got from Robert are magnified. And one of them that comes to mind when talking about generalized principles is he studied a lot with our Buckminster Fuller. And a lot of people think, well, that's really who Rich Dad was. It's not. It's not. Robert had many mentors, but one that he does hold close to his heart is our Buckminster Fuller, Bucky Fuller for short. And he had these things that we would study called generalized principles. This is really important. A generalized principle could be defined as something that is true and could be applied in all cases and all times in the universe. Like anywhere you go, any generation, any time frame, any era, any planet, they just are universally true all of the time. And so when you ask the question, does Warren Buffett's stuff still work today? Yeah, there's stuff like, I'll give you an example. Buffett's not buying a lot of stocks right now, and neither am I. I'm cash flowing. I'm using cash to make money, not stocks as much. Well, you have your cash flow that doesn't change, but I'm not acquiring stocks. And I'll tell you why. If you look at the Shiller PE right now, the Shiller PE index, it shows how much we pay to earn $1 in an S&P Jack in the Box. In other words, if I buy the Jack in the Box that is the S&P, those 500 companies, and they turn the crank in the work, when it pops out, $1 comes out, right? So every time $1 comes out, what is the cost of the box that produces $1? If you look at it right now, the highest it ever was 2000 in the dot-com boom, because there were prices with no earnings. So you're paying a lot of money to get that dollar, because a lot of companies had high prices with making no dollars. You're paying for something that didn't produce. It is not lost on me that AI has created a similar, it's not exactly similar. It's more solid than the dot-com was. But there's speculation of who's going to be able to do what, and there's a bit of euphoria where people are greedy. So the reason stocks are, if you look at Shiller PE, it is almost ready to eclipse, and we're almost at an all-time high. So let me kind of break that down into English. The median over the last 140 years of stock market stuff, about 140 years, the median price to get $1, you're paying about $16. So you're buying a machine, you pay $16 for it, and after a year, you get $1 back. That's usually what the median is. It's in the high 40s now. So you're paying over $40. You're paying over $40 to get $1. That's 40 years in terms of earnings to get an ROI. Now, why are people paying it? They're concentrating on price and growth. They think the prices are going to go up. But as far as the earnings go, it's expensive. And for a 401k guy, that means that they probably are not increasing the amount they're putting away. They're just paying the same and getting much less asset. In other words, if they used to have, $160, they could buy $16 worth, right? And you get 10 units. Well, if it's $40, now you get 40 units, I think the math would be. So you're getting far less for the money being spent, and you're paying far more. Well, what did Buffett say? What's his greatest maxim? Number one on the list. Well, number one maxim for Buffett is buy stocks when they're low. Be greedy when people are fearful. Be very fearful when people are greedy. Right now, they're greedy. And so that maxim is true in all cases. Any stock chart you show me on any planet or country or time frame, if you give me a 10-year chart and you say, Andy, when's the best time you should have bought? I'll pick the lowest price every time. In every case, forever, eternally, I'll say, that's where I wish I would have bought. It's always at the most fearful, darkest cloud, awful. You always wish you could pick that bottom. And most people buy in at the top, which is why the prices are so high right now in the Shiller PE index. So I would say that's number one on the list. Is that absolutely applies today, tomorrow, 1,000 years from now. You want to buy stocks when they're low, because you get your rate of return increases, because you're going to get your money back faster if you buy them low. There's less money to get back.
Now let's do another maxim of Warren Buffett, and that's invest in what you understand. Now, to add a little context to that, I remember being at a Berkshire Hathaway shareholders meeting. It was probably 2013, I want to say ish, give or take. And someone asked, and the great thing there, you get to ask Warren Buffett anything that you want, from favorite ice cream to stocks, right? Yeah. Anything under the sun.
Q&A.
And one of the questions was about Apple, and he hadn't invested in Apple at the time. And it was kind of mind-boggling, but he said, I don't know about technology at this time. I don't understand it. I'm understanding. And he quoted some of the books he was reading. So the question is, invest in what you understand. Why is this still one of the most important rules for investors?
Well, I don't know. It might be a common sense thing to say, let's just take the opposite of that. What if you had a strategy to always invest in things you knew nothing about? I mean, just intuitively, a person say, yeah, what's your strategy? Well, I try to find something I know nothing about, and I put all my money in that. I mean, just intuitively, that's a recipe for absolute disaster. And so the key is okay, well, what if I don't know anything? Well, then that's where you learn. The most important activity every day, Buffett talks about, there's a lot of quotes on this, is he learns every day. The guy reads forever and talks to people and calls people. And he had Benjamin Graham, who was his mentor. He learned. Now, Buffett understands business pretty well broadly, because if you understand, I understand what he means by the details of it, but broadly, if you understand financial statements, that's also universal in principle. 2 years ago, before Munger passed, they flew to Japan and they invested heavily in some Japanese companies. How can you do that when you don't even speak Japanese? I really think so, right? And so, they don't know who the vapors are either. Gen X, they're gonna tune me out, man. Like, what do you mean? They don't even get the vapors right. I saw you got the vapors, the one-hit wonder vapor reference.
I got that subtle little slip in there. Yeah,
we're speaking Japanese. I really think so. So you look at their ability to go to Japan. Why is that? Well, they understand cash flow. They are fundamental analysts. And here's another true principle. If I go to Japan or anywhere, a business is going to have three things to record. It's going to have an income statement, number one, income expense. Every business has income, every business expense. They're going to have assets, liabilities, they're going to have a balance sheet, and they're going to have a statement of cash flow. 3 cash flow patterns of money that came from operations, where they earn the money that came from borrowing, finance, and money that came from assets, investment, the buying and selling of an asset. And their bank account will reflect those 3 cash flow patterns, those 3 cash flows. So that's another universal deal, that I can invest in China or South America or wherever if you have an understanding of those things. So again, fundamental analysis are generalized principles. They're true in all cases. You're either growing or shrinking, you either have a deficit or surplus, you either have a large equity or not. Universal principles. Fundamental analysis is it's not Buffett's. When you say, what are Warren Buffett's thing? He didn't author these. He tapped into, it's like gravity doesn't belong to Buffett, but he uses it when he walks every day. He didn't invent the car, but he drives one, to the office every day. So yeah, I don't even know that they're Buffett's maxims. I think maybe he's just tapped into some truths so plainly that we attribute them to Warren, which isn't wrong to do, because he's mastered these and been exemplary in execution.
That's amazing. Well, let's do this. Let's take a quick break. Buffett's principles have stood the test of time, but the markets have changed a little bit. So when we come back, Andy is going to break down how modern investors can adapt these timeless rules to today's faster and more complex markets. And don't forget, go to stockcastbonus.com, download your free resources. This is where classic investing meets modern strategy. So stick around. We'll be right back.
So far, it's been great. I needed a source where I could really enrich my education through stocks. I didn't really have an avenue for it, and it's helped me a lot. The simplicity has really gotten me on the track to where I enjoy the learning, as well as it's really solidifying in my mind. And they're not just trying to sell you something, they really care about the people that are in the course, and they really do care about you and your personal goals, and what you want to do is to help you and your family and whatever your goals are in life through that. So it's really been great.
Welcome back to Rich Dad's StockCast. Andy, let's talk about evolution. If Buffett's principles are timeless, how should investors apply them in today's environment? You know, for example, one of them is buy stocks at a fair price. You know, why, or buy great companies at a fair price. Why is that important today?
Great price. Yeah, Buffett changed a little bit when he began to partner with the late Charlie Munger. Buffett used to be a guy that would you talk about a cigarette or a cigar that had one more puff in it, one or two more puffs in it. So often what would happen is when you see a company starting to weaken, the price can go down faster maybe than people are running for the hills because it's a forward-thinking instrument. He'd find these that were low priced because things didn't look good. But he says, but they probably got a little more puff or two left in them, and then he'd buy them and sell them. And Munger is really the guy that came in and changed that for him. And he said, you know what? We're never going to be big if we're buying cigarette butts with a puff left. We want to buy big stuff. And probably the big one they went in was Coke. And they said, we would rather have a really good company and pay fair for it than just a fair company and feel like we got a good deal on it. We'd rather have a really good company. So they started thinking about company quality, and it introduced the idea of a moat, which means that it's not impenetrable. You can cross a moat, but it makes it harder for the competition. And the deeper the moat, the wider the moat, and the more sharks, alligators, and hot lava or whatever you want to put in your moat, the tougher it is to take down a company. They can all fall. Every one of them can fall. No one's impenetrable. So the idea of a moat is not force field, it's moat. And so that shift was big. Well, we can apply that today, every bit. I think technology companies have a bigger risk of obsolescence. It's harder to believe that a big strong company could be the next Palm Pilot, Word Perfect, Quattro Pro, Netscape, Napster, that are just in the graveyard now, right? They seem like the big thing. And even a company like Facebook is not that tough to replicate. Instagram, for some reason, Facebook had to buy them because they were going to get taken out. And, before Facebook was MySpace, right? And so yeah, the idea of buying a good company at a fair price, and right now a lot of prices aren't fair. They're unfair for what you get. So yeah, that fits all the time. That doesn't fade with the evolution. Complexity, get as complex as you want. Go Elon Musk it and get really complex technologies and robots and AI, and well, it's still an income statement, a balance sheet, and a statement of cash flow. Those don't change ever. They never will. There's nothing else to measure that's important.
Now let's go. I want to give you one more, Maximin, and I want your thoughts on this. Margin of safety. I love that term. Why is downside protection just important today as it was decades ago?
Yeah, let's talk about let's define what that is. For example, I'm not the real estate investor that Robert Kim, Kenny McElroy, Than Merrill, the friends I have that invest heavily in real estate. Let's not. I would be uncomfortable pretending I'm in their league, but I do have a significant part of my wealth in real estate. So let's just take a real basic example, like a single family home. One of the opportunities I have is to refinance those when rates are the right place, and pull equity out, replace it with debt, and take that equity and then go invest it tax free. So that's a great, Kenny and Than, Kim, Robert, they get that. And so borrowing allows them to take money that renters pay off. I mean, imagine what if I gave you my Amex card and it has no limit? It's a charge card, not a credit card, so it has no limit. And I says, Dell, take 24 hours, anything you put on that card, you get a keep, but I'll pay it off. I mean, you would go as long and you'd swipe that till it was broken, right? because you don't have to pay it off. That's essentially what's happening is we're drawing money from real estate tax-free, and the renter has to pay it off, right? They have a lease and they're going to pay that rent. The margin of safety comes with how hot you run that, because I don't pull all the equity out, because to me it's about what the new payment would be relative to what rent fluctuation could be. Or you wind up with like people in the subprime meltdown where you're underwater, where all of a sudden rents fall and you're no longer cash flowing, you're paying and you're underwater. And if you get too many of those, you're going to be in big trouble. And that's where when Warren Buffett swoops in and buys the thing for a song, because you've got to get out of it, right? So that margin of safety means it's kind of how hot you run things, right? And if you look at it now at a financial statement of a company, like Apple is really a strong company. They have a huge margin of safety, even at today's prices, because they have so much cash, so much. There's just certain companies that have a lot of wiggle room where their margin and their profits are large enough that they could absorb some things. Dow Chemical had to drop their dividend because the Trump tariffs put so much uncertainty in the market, especially international markets. You got an international company like Dow Chemical, they've got raw materials coming from all over the world, right? They don't know what the tariffs would do or how long they last or what's going to happen. So they had to scale back to be safe. They said, look, we got to scale back our dividend. We had some plants we're going to build. We're not going to build them because we don't know whether they're going to be profitable anymore or not. So we're not going to build these plants. We're not going to hire these people. We're not going to hire this workforce that we just have to lay off. That was a margin of safety call to make sure that whatever storms may come, they're going to be around. And they will be. They will be. So that margin of safety, what circumstance would that be a bad idea, or where that would not have it doesn't have a shelf life. When it's having a margin of safety, all of a sudden going to be a passe idea. These are just principles that will endure no matter how complex you want to act like the market's getting. It's not really that complex. It's business. It's simple. And Buffett, all these maxims are simple, aren't they? Have a moat, buy a good company at a fair price. Buy when people are terrified, not when they're greedy, right? I mean, very simple maxims, as most truths are. As most truths are, they can be simplified.
I couldn't agree more. I think that's when you really understand something, you can simplify it. And we're not talking about iron condors and whatnot. We're talking about just buy when it's right, right? Now, going with let's see how I can phrase it. Let's say Warren Buffett were to start over again. Okay, let's say he's 21 again, coming into 2026. He understands the strategies. What is he doing different today? What's his first move? So, using those principles, what is Warren Buffett doing different than he was, 60 years ago starting out?
I wish I could ask him that question. Obviously, he'd answer it better than we could. We'd just be speculating. I do think he'd have moved from his cigar butt strategy to good company, fair price strategy sooner. Probably would have started with that. He was able to raise some capital as a young man. His father was a stock guy. His dad understood brokerages, and so he learned a lot from his father. But he credits his dad quite a bit. But the stuff he learned from Benjamin Graham, he didn't even know Benjamin Graham was still alive. And when he found out he was at Columbia, that's when he decided to go to school. Was specifically to go to Columbia University to learn from Ben Graham. So I think the Ben Graham stuff came along pretty early, and that's margin of safety stuff, and that's understanding the difference between speculating and investing is a Graham deal. I don't know that he would have done much different other than probably would have moved to Munger type of mindset and probably skipped a lot of the cigar butt last puff mindset. I think his strike zone, another one he has, is he talks about, baseball player Williams. He talks about the pitches that he can hit and to swing at the pitch, kind of know what your pitches are, where your strike zone is, kind of like you said about your area of your circle of competence, I think is the word or the phrase. I don't think he'd do much different other than that. He's been patient. The other thing about Buffett that is underrated, there's two things we should talk about. I don't know how much time we have, but there's really two things we should talk about or we'd be remiss. The first one is temperament. Munger and Buffett are unquestionably geniuses. There's no question. They could sell 20 IQ points and be fine, right? They could. They talk about it all the time. They have the IQ to spare. I only have about 20 to my name, so I can't sell all 20 of mine. But their temperament, often their genius eclipses the secret sauce of temperament. And I would say that the biggest growth I've had in my investing life is trying to get control of my own. I'm very affective, very emotional, very impulsive. I'm brought to laughter, anger, tears very easily, very emotional. And learning to temper that, bridle that, and adopt an investor temperament has been bigger than knowledge for me. It's been an area of emotional knowledge that's been very, very, very important area of growth. Still battle it because I'm still my own neurology genetically, but having a better temperament has been big. That second thing that we would be so remiss, Buffett, if you study his speeches and what he said, and you say, what did the author say? And what did Buffett really say? You'll often find what to a person who doesn't know his stuff well would interpret of hypocrisy or talking out both sides of his mouth. So let me give you one of the more common examples of what appears to be talking out both sides of his mouth. On one hand, you'll go to that annual meeting, and the late John Bogle, who went as Jack Bogle, John Bogle, same guy, we called him Jack. He's in the audience, and he has John Bogle stand and get a round of applause for the Vanguard Index Fund. Now, what is the Vanguard Index Fund? Well, the Vanguard Index Fund is a commitment to averageness minus a smaller fee than normal. That's what it is. You're basically going to commit to diversification. You're going to buy the whole dang market. And you're going to buy it from Bogle, and he's going to say, "Look, we're not going to pick anything. We're going to have the good, the medium, and the bad, and we're just going to charge you a lower fee." That was the genius of John Bogle. And he says, "Yeah, you can't beat the market. Just as well diversify. And if you just did that and bought that, just let the market run and believe in American business, that." He says for most people, that'd be the best thing to do. So he's endorsing diversification. You can find another speech, probably in the same conference, where he says, in our view, it's madness to do that. So what he endorses in one sentence, he says is madness in another. And he says, it strikes Charlie and me as madness to take all of your stocks in your list of attractiveness, is the way he says it, and just put an equal amount of money in everything. Why would you not front load those in the high part of your list? He's also said you don't need more than 30 stocks. He says it's crazy. Probably don't need more, 50 or even more than 30. He says actually one stock like Coca-Cola can take you to the promised land if you get the right one. So on one side of his mouth, he's plotting John Bogle, saying, yeah, most people would be better off doing that. And then he says, oh, no, it's madness. He said diversification is a confession of ignorance. And that's the bridge between the two conversations. If you understand that, you can understand that. Then you understand that Warren Buffett is cognizant of audience. I speak to non-basketball people differently than I speak to basketball people because the non-basketball people have no idea what we're talking about. And it's best for non-basketball people to just keep their mouth shut and watch the game, watch the ball go in and clap when it goes in, and not pick apart the game because they don't know it. They just don't. And so he is very cognizant to the educated and the uneducated. And in every instance where it seems like he'd be speaking out both sides of the mouth, he's just addressing an entirely different group. And so when he speaks to the educated, he talks about fundamental analysis. He talks about moats. He talks about company ownership, right? When he speaks to the uneducated, he's talking about index funds. In both arenas, he talks about how fees, 1% is enormous over time with wealth. 1% over Buffett's lifetime is about 40% of the money. Think about that for a minute. 1% less is about 40% of the money over a 65-year compounding career. Isn't that crazy? 1% takes about 40% of that. 2% takes 80% out. 2.5% takes 80% of your wealth out. So yeah, Buffett, we'd be remiss if we didn't talk about temperament, and we'd be remiss if we didn't really get clear that his deepest gems, this stuff you talk about, Warren Buffett principles, they're for the educated. Everything else for the uneducated, just go buy an index fund and just tap out. If you're going to be uneducated, just tap out. Buying an index fund is a commitment to averageness less a fee, which is why on the Spiva report, there's a reason for this. The Spiva report, you can spiva.com, S&P 500 versus actively managed funds. You can look at it every year. 90% of funds fail to beat the S&P. Why? Because they are the S&P minus a fee. So if you're going to mimic the S&P and then charge a fee, here's the S&P, here you charge your fee, and you're never going to beat them. You're never going to beat them. So I think that's important to bring up, that when Warren Buffett is going to speak, he's going to speak most of the time to people who want to be educated, business owners, as opposed to participants in a freaking 401k that just charges whatever fees they charge.
All right, final question, Andy. Educated versus uneducated. So if someone wants to become more educated, action step, what do they do?
You asked this most podcasts, and I answer the same way most podcasts, is you can go in any direction and improve, man, by doing something. Action of any kind. If you haven't read the book Rich Dad Poor Dad, go buy it. You'll be a better investor if you do. If you haven't played the cash flow game yet, go get one, start playing it. You'll be better if you do. If you haven't been to stockcastbonus.com yet and got your downloads for free, go do it. And you'll be better if you do. If you have no assets at all, go buy a silver eagle, and you'll be better having an asset in your column than if you don't. Open a paper trade account, begin practicing, join our mentor club and watch us trade every week. Imagine that. Imagine spending a year watching a trading session once a week with us, where you would be in a year. So, it's kind of like service. There's a great pastor, his name was Jeffrey Holland, the late Jeffrey Holland said, go in any direction and you'll find someone you can help. Go in any direction, there's someone you can help. Well, it's true with knowledge, in action. Do something, read a book, open a paper trade account, make a mistake. Would be a great way to learn. People say it all the time. Robert says it, never waste a great mistake. They're great learning opportunities. Go make a mistake and you'll learn. Any type of action will teach you, whether it was a good action or an action that's a learning experience. Just don't be a content person who just consumes endless content. It's very dangerous, because the dopamine hits that people get with illumination, the aha moments they get, the way our neurology works is sometimes talking about wealth and dreaming about dreams and wealth can give us the same illusion that we've already arrived when we have not. And it takes clicking that mouse and buying that stock to put it in your asset column to get those dividends and that cash flow, and takes that mouse, clicking it, getting that covered call money. We call it click and get paid. Well, if you haven't clicked and got paid this week, if you haven't taken your mouse, clicked, and watched money flow to your account, I can help you. I can help you a lot. So, yeah, what actions can people take? Hell, anything, any direction, any action is better than scrolling. That's not action. Scrolling is not action. Action's action. Purchasing assets is action. If you make a mistake, great, man. You just learned something. So is that a rant? That's not quite a rant, but it was close.
That was close, but I love it.
It was in the ballpark.
We get, listeners, principles matter, but like Andy says, application matters even more. Taking action is so important. Just go somewhere, do something. And the investors who win long-term are the ones who take timeless wisdom and apply it to today's market. And again, big thank you to Andy Tanner for breaking this down for us. Listener, if you want to learn how to apply proven investing principles in today's market, go to stockcastbonus.com right now. You'll find free tools and resources to help you to invest smarter. And again, if this episode has given you any sort of value, make sure you like it, subscribe, share it with someone who respects Buffett but wants to invest smarter. Listener, you're not here by accident. You're building something that most people won't. So stay smart, stay invested, and we'll see you next time.
This podcast is a presentation of Rich Dad Media Network.